Dominick Tavella, founder, president, Diversified Private Wealth Advisors. I love that when we look at this, you know, there's always the recipe and then there's always the personalities that go along with it. Your thoughts on what's going on here in the market, first of all? I mean, you can't chase it or hope to time it.
Well, in fact, a lot of people are. I think they're looking at this as the light at the end of the tunnel, and clearly we're starting to see the number of new cases of the virus going down, number of deaths going down, and I think a lot of people are assuming all good. I do think in the end, all good, but I think also it's going to take a lot longer than people expect and a lot longer for companies to recover. Whatever the new normal means, I think it's further down the road. So I certainly would be careful here about putting or aggressively putting money to work.
So your recipe here is looking at your the volatility that we're seeing. You definitely don't want people to take any dumb risks, right? So what do you expect people should do? I mean, based on their age, for example, you have sort of your own recipe of doing this.
Yeah, a formula that I literally learned in the early 80s is you take the client's age, you subtract it from 100, and whatever's left over theoretically should go in the stock market. The rest, the age component, goes in the bond market. So a 20-year-old would have 80% of their money in the stock market and 20% in bonds, where if you had an 80-year-old, 80% in bonds, only 20% in stocks. But the reality is that people have their own personality and their own tolerance for risk. And risk, we're talking about volatility. Markets going up, markets going down, not the hot stock of the day. So if you can deal with the volatility, you can have more of your portfolio in the more volatile component, stocks, and less in bonds. If you can't sleep at night, if that volatility really makes you uncomfortable, then you need to have a more conservative portfolio, i.e. you would push more of your portfolio towards the bond side and less towards the stock side.
Right, right. And, you know, my dad was always a very conservative investor. And, you know, I get it because every time we sell off and I have a heart attack if I'm going to lose, you know, a small amount of money. So some people just have better risk tolerance than others. Tell me about the balanced fund, the Vanguard Balanced Fund that you like as at least one investment.
Yeah, so you know, we're always trying to explain this theoretically to clients, and believe me, everybody would like positive returns, and people love volatility when the market goes up. They just don't love it so much when the market goes down. So one of the examples, and we use this as a core fund in our asset allocations, is the Vanguard Balanced Fund. It's about a 60-40 portfolio, 60% stocks, 40% bonds. It is actively managed, but very, very low cost. And if you look at the last 15 years through, and we've had some crazy up and down days and weeks and years during that period, the fund has still averaged about 7% a year. Now, that doesn't guarantee going forward what the performance is going to be, but it shows you during volatile times, having a boring conservative portfolio can give you a very reasonable rate of return.
Right, and I know I was looking at this one, was you were getting back about 7%. Not that you get that every year, but I think people would be happy with even a few percent in this type of an environment. What do you think of other things like crypto and Bitcoin and things that seem to be a little more risky?
So let's just focus on the balance fund for one quick second. That fund, 7% a year, that really means your money doubles every 10 years. That's a pretty good return. Now, I'm not saying cryptocurrency is not the way to go or the hot stock of the day or the hot IPO, but if you're living with that volatility when the thing soars through the moon and then comes crashing down and it really makes you nauseous at night, that kind of volatility will ultimately push you in a place where you're going to sell, but not when the market is high. You're going to sell when the market's low. That's when people panic. That's usually when they make the big mistakes, when markets are low. So if the volatility makes you nauseous, stay away from the volatile stuff. Even if it can make you money, it's going to catch you at the wrong time, in the wrong place, and ultimately you end up selling at the bottom.
Yeah, and I know you said no dumb risks. I mean, what kind of risks do sometimes people ask you to do that you say, no. I mean, I'm a pro and I really can't even do that. Well, I mean, have you been put in that position?
And recently it's been with oil. Now, we've all seen the volatility and craziness of oil, and oil is cheap.
Sure.
And it's cheap. it's cheap for a reason, right? People aren't driving, people aren't flying, commerce has come to a standstill or pretty close to it. So oil is cheap. And so people are like, how do we buy oil? How do we take advantage of it? How do we put some of our capital? And look, I can understand as a long-term investment, maybe it's a good time to buy into like an ExxonMobil or a Chevron or a Shell. But you can argue this is going to take a very, very long time. And you're speculating in the short run, just how long is it going to take for this economy to recover? So you can't, you got to be much more balanced in your approach to investing. Own the S&P 500, go buy an index fund or the Vanguard Total Bond Fund, create a balanced portfolio. And I'm sorry, you're not going to get rich, but you won't get poor. Make that big bet, and sooner or later you're going to get poor.
I'm glad you brought up oil, because that's definitely a question people have been asking me. Should I get into oil? Because they love the dividends, but we've already seen a couple of bankruptcies. We continue to see the volatility. Not sure where the demand is going to come, and there's so much supply. It's floating on the tankers. You know, I mean, they don't know what to do with it all. So it is a tricky trade. Dominick Tavella, great to see you.
Thank you.
Thank you. Founder, President, Diversified Private Wealth Advisors.